Hi everyone, and welcome to our quick summary of what Jerome Powell's just been saying about monetary policy. Hopefully this will be shorter than the actual meeting. The goal here is just to kind of interpret it from an investor's perspective and try and convert the Fed speak into tangible things which we can understand as investors. So let me just quickly run through the kind of opening statements that Powell made, but also kind of elaborate on it with some data. So let me just start this up and we'll get cracking. One moment. I'll just get OBS in business. Right, okay, so so this is how markets were looking at what the Fed was going to do before they actually did it. So these are the meeting probabilities backed out of the Fed funds futures market, and this was just minutes before the meeting. So this is the rows here are the individual meeting dates. So the one today, November the 2nd, was, you can see that the Fed funds rate was going to go up by 75 basis points, and that's exactly what happened. So 0.75% was a rate increase, a very large move, but of course we're now getting used to very large moves. And if we look at the next meeting, which is in December, that one before this meeting was only going to be raised by 0.5%. Then another 0.5%, that'll be for the February meeting next year, and then 0.25 for March. And then finally, when we get to May next year, that's when we stop getting rate hikes. This is what the market was pricing in. And we'll get the first cut, according to this, in September of next year. So clearly the Fed's message that it's going to raise rates, keep them at a restrictive level for a long period of time, has got through to the futures market for the Fed funds futures. So that was priced in for this meeting, 0.75%, and that's what happened. So no surprises there. If we look at the dot plots, this is from the September meeting. This is where Fed policy members, FOMC members, this is the median expectation for where rates will be for each of the years ahead. So for the end of this year, 4.4, the end of next, 4.6, 3.9, and then 2.9 for the long run average. Now, the meeting today, after they raise rates by 0.75%, the middle of the lower and upper target for the Fed funds rate is now 3.9%. So that's the blue dot you can see here. So very aggressive tightening over the course of this year. That's the message that Powell was saying. Look, we've come a long way from zero rates to 3.75 over a very short space of time. And, that's clearly had an effect on some rate sensitive parts of the market, such as the housing market. That's one of the things he pointed out. Now, it's interesting if you look at the there is something called a Taylor rule, which lets you say, okay, well, given the level of inflation, and also the other half of the Fed's mandate, of course, is maximum employment, can you back out from historic Fed actions where the Fed funds rate should be? Now, as a kind of fun exercise, you can build your own kind of Fed funds tool, and I've done that, and I've actually released that today for members. Let me just show you what it looks like. So we have these things now called trackers for members, just so you can see, and for members, to be able to refer to this stuff. So we've got stuff for stock valuation, Schiller PE, forward PE, macroeconomic stuff, but also fair value models. And I've added this as a fair value model. It's still, the ink is still wet on this page, so I haven't added an explainer for it, but we've got gold fair value, silver fair value. Now we've got the Fed funds rate. So what goes into this model? Well, it looks at the rate of inflation. It looks at the stock market, interestingly, and it also looks at the unemployment rate. And those feed into a prediction for where Fed funds should be. And what's pretty shocking is the model predicts that it should be at something like 8.6%. So much higher than it is right now. And one of the comments that Powell made during the meeting, somebody said to him, well, some people think that the rate of the Fed funds rate should be roughly higher, just a little bit higher than the rate of inflation, which of course is now above 8%. So Powell actually said at that point, what you should put into the model is not inflation today, but a forward-looking measure of inflation. And this is because Fed policy acts with a lag. So that's what you should put into the model. So, I haven't tried that, but it's kind of fun to play around with your own Taylor rule. But it turns out that, the stock market does have a bearing on Fed policy. When stocks are very high or accelerating upwards, if they've got a very strong momentum, that tends to make the Fed more likely to hike rates. And if markets have been falling sharply, it makes the Fed more dovish. It makes it more likely to cut rates. But at the moment, clearly, its mandate is very much focused on inflation, and it's not there to bail people out. So what you should use instead is a forward-looking measure of inflation like the 5-year ahead, 5-year expectation for inflation. So this is looking 5 years ahead and looking 5 years out from that point. And this is also interesting because it shows that expectations, at least in the futures market for inflation, at least for the forward rates for inflation, still remain pretty much anchored, not much above 2%, which is the Fed's target. That's the dashed red line you can see here. So expectations, also if you look at surveys, are still not showing that people expect inflation to stay at 8%. They're coming back down to something like 2%. So that's good for the Fed. It shows that it is credible. He also pointed out that the jobs market is still red hot in the United States. So very tight labour market. And the unemployment rate at 50-year lows. Inflation's very elevated. And this is because of the supply-demand imbalance. Now, clearly, the Federal Reserve can't affect the supply side, the companies which produce goods and services, because if you want to get inflation down, you could also boost supply. So then you have, more abundant resources. So the Fed can operate on the demand side, and it's trying to reduce demand for goods and services and push down inflation that way. And if you look at the job gains, they have been robust. So this is the non-farm payrolls in the United States. Think of this as the number of people who don't work on farms who have a job in the United States. It's roughly at 150, it's over 150 million currently. But what people look at is the monthly change. Now, just to absorb new entrants to the jobs market as people graduate, that would be about 100,000. But recently it's been very strong. So 263,000, 315,000. And if we zoom in on that, you can see that the average over the last couple of months has been around 300,000. And during normal market conditions, we might expect that to be like 100. So very robust job gains. Why are job gains strong? Because there's demand. US citizens are going out and shopping and buying stuff, and they do have a lot of savings. This is one of the things that Powell is stressing. Even though the savings rate has fallen, they have an aggregate savings which still exist after the pandemic. Because remember, people saved a lot during the pandemic because they didn't go out and spend. And those savings are still there, and domestic balance sheets are still flush with cash, according to Powell. And that's what's keeping demand strong. Here's our unemployment rate, and you can see that it's as low as it's been since, the last time we were here was like the 1960s, when we had a 3.5% unemployment rate. So very, very low. Now, if we look at inflation, you can see that it's still very high, 8.2% for CPI. If we strip out the volatile food and energy components, even the core, which is mostly services, is rising very strongly now. Not only rising, but it seemed to accelerate at the latest print. And the Fed's very disappointed about that. It shows that it's going to have to be more aggressive in order to get that core number under control. Now, the actual measure of inflation which the Fed uses is personal consumption expenditures inflation. And there again, you can see that core has actually been accelerating for 2 successive prints. So everything points to a Fed which is more aggressively raising interest rates. So no sign of a pivot whatsoever. And we'll come on to that in the summary at the end. Obviously, he mentions the war in Ukraine, so that's more of an effect on European countries. So if we look at inflation in the UK, Germany, Italy, the US is less affected by the energy constraints which Russia's imposed after it weaponized gas prices and now maybe other energy commodities. So I think the effect on Europe is bigger than it is for the US, which has got a much more resilient and self-sufficient energy infrastructure because of shale oil. So that's Ukraine obviously affects the global price of energy, and that indirectly affects the US as well. But if you do look at US gasoline prices, they have been coming down recently, and we'll see that in a moment as well. So the point was that yes, they're going to raise interest rates to a range of between 3.75% to 4%. So 3.75 to 4 is where we're now sitting for interest rates. And not only that, but ongoing increases will be appropriate. So they're not finished yet. That's the story. Now, it's kind of interesting. These poor guys at the FT have to write these articles really quickly as the Fed announces stuff. And the actual headline was US stocks rally as the Fed raised the prospect of slower rate increases. And you can see that there's a surge in the value of the Nasdaq and the S&P 500. But then just moments after that, I think markets realized that Powell wasn't saying anything that was suggesting a pivot or a slowdown. In fact, he was saying the opposite. And then markets tanked, right? So the S&P fell 2%, and over the course of the day, the Nasdaq, last time I checked, was down about minus 2.7. So clearly markets don't like this message because it shows the Fed's going to be more aggressive, and if anything, they're going to increase their point at which they think restrictive monetary policy is going to have an effect. So the September dot plots, in other words, were not aggressive enough. Powell thinks, he was hinting that the next dot plots, which we'll get in December, will actually move up again. So, expect rates, the place where they're finishing is going to be higher than it was expected to be in September. So there's also the question about quantitative tightening. So we've switched from QE, quantitative easing, which is bond purchasing, to quantitative tightening. The Fed's going to shrink its balance sheet, not by selling treasuries and MBS, mortgage-backed securities, but by simply letting them mature and not reinvesting the coupons and the principal. And if we look at that, it really has got started now. Compared to where it's been historically, obviously it's still elevated. It's still above $8 trillion. But you can see that it's starting to shrink. It's fallen by about 2.7% so far. And if we zoom in on that top bit, you can see that 2.7% shrinkage and the acceleration downwards. So they really have got underway with their quantitative tightening. And all of this makes it more difficult to get things like credit, for example. So why do we have to have tightening conditions? Well, this is how you reduce demand. So if you're trying to get a loan in the US, there's something called the Senior Loan Officers Survey, and you can see how difficult it is to get a loan. So if you've got tight conditions, so if this thing is red, it shows that banks are actually restricting credit and becoming tighter in their stringent criteria for lending you money. So that's clearly happened recently. And it's happened for small firms. So if you're a small company trying to get a loan, it's now harder. And if you're a large and middle market firm also, you can see conditions tightening. So this is going to have a cooling effect on credit availability and, of course, on the US economy, because they're trying to get rid of demand, right? They're trying to reduce demand at least. Now, it's interesting, if you look in the US, some CPI components are falling. So here I've compared the annual changes in this left-hand panel, and this is the latest CPI numbers from the US in September. So these are the year-on-year changes here, and you can see airline fares up 40%, fuel oil up 40%, gas up 33%, gasoline up 18%. But if you look at the month-on-month changes, you can see that gasoline is down 5%, fuel oil down 3%. And remember, used cars and trucks, that surged because of the chip shortage. Well, now it's falling month on month. So we are starting to see these drivers abate, and that's good news. However, if you do look at the jobs market, it's still very, very tight. And one of the preferred measures that Powell looks at is the unfilled job vacancies per unemployed person. So how many jobs are available per person who's unemployed. And if there are lots of jobs available for every unemployed person, then that's a very brisk labour market with lots of demand for workers, which outstrips supply, and that's inflationary. And you can see that, those two are kind of superimposable, the spike in inflation, but also the tightness of the labour market recently. So still a very tight labour market. And if you look at the average earnings in the United States, how quickly they're rising, you can see that the blue line is the rate at which wages are increasing. It's currently 5%, which is well above where it used to be. That should be roughly in line with inflation, but it's not. It's double the Fed's target rate. So this is inconsistent with its 2% target. It still wants wage growth, but it wants wage growth in line with its 2% target. So still negative real wage growth. So for the average citizen, this is a very painful time because their wages aren't growing as fast as inflation, as the cost of living is increasing. But the Fed clearly does not want this. They want earnings growth to be back down at 2%. Otherwise, we could get this wage price spiral. There's no evidence that that's happening yet. You can see that wages are still well below inflation. So hopefully inflation comes down before earnings start to catch up, because once a wage price spiral starts, it's a very difficult thing to stop. So just to summarize then, I think the key message was that the Fed has still got a long way to go. It seems difficult because we've just come off a zero level. We used to free money. Well, it's getting tighter and it's going to get even tighter. And the fact that the jobs market is still so tight and wage growth is still strong and inflation's high means that the Fed is still feeling its way, and it's thinking that it has to be even more restrictive. So rates are going to get even higher. And it's premature to discuss pausing. That's very clear. So all this talk of a pivot, of slowing down, well, we're still a long way from that. It's really important to understand how committed the Fed is to getting inflation under control. If that does reduce demand and if it does increase unemployment, that's something that the Fed is willing to suffer, or at least willing to inflict on the economy. And a lot of people are quite upset about that because, we're talking about millions of Americans losing their jobs in order to reduce inflation. And that's an unpleasant medicine. So some people are thinking that, the Fed is actually approaching the point where it's over hiking and being too restrictive, and this is going to cause a lot more pain than it needs to. So that's the big debate at the moment. The other point that Powell was making is that the lesson the Fed has learned from history is that if you take the brakes off too soon, if you start to reduce rates too soon, inflation can get back out of control. To use a metaphor, think of a forest fire where you've still got embers burning under the ground. And if you don't douse them, then the fire will start again. So inflation could have a double spike. So the Fed clearly doesn't want that to happen, and it's going to be very restrictive with its policy. So that's it. So that was my very brief summary, I hope, of what the Fed just said. And also it kind of explains why markets didn't like it, because who's going to like the fact that the Fed's going to be even more aggressive than it's already been? And if you look at what sold off, it was largely small cap growth, which is not good news, because that's where most of the pain has been already over the course of 2022. And we saw the NASDAQ sold off more than the S&P. Brilliant. So let me switch back to me, and I'll have a quick look at what Laura's telling me in our document. And hopefully I won't share it with you this time. Last time I was just chatting away and you could see Laura's comments. So yeah, please do super chats, because that helps us obviously. We'd appreciate it if you did do that, because obviously we get some money if you do that. And we also favor people who are our supporters on YouTube. So if you are a supporter on YouTube, then you'll be pushed to the front of the queue to answer a question. But Failing that, I will answer a few questions now over the next few minutes. Last time it took a while to kick off and then it kind of went crazy. So let me just zoom up to the top of this document here. Okay. And let's see what we've got. Okay. So let me just try answering some of these questions, which I can see. Adam Hopkinson says, looks like the market got way too far ahead on the hope of a pivot. I absolutely agree. I think that was a kind of crazy idea. Powell has been very clear that a pivot is very unlikely given what the data is showing us right now. You know, with a red hot labour market, with inflation running above 8%, and, you know, no kind of wage price spiral, but still, that's still a threat. Looks like more opportunities to buy quality at lower prices. It's interesting. Quality as a factor has actually done really badly over the course of this year. And I agree with you, Adam. I think, you know, this is a kind of environment in which quality, particularly the leverage filter, which is part of a lot of quality funds, I think leverage is a really important thing to look at right now in markets, because if companies have to roll over their debt with much higher debt servicing costs, that's going to be a problem. So, you know, zombies, the zombie apocalypse might be a problem in the next year or so, particularly if rates stay high for some time, which is clearly what the Fed's talking about. Chris Wood. Oh, Ned Flanders. Thank you, Ned. Has a super chat. We appreciate it. Ned's a regular question asker. Love the character on The Simpsons too. Hey, Ramin, thoughts on IGWD for sterling hedging? So let's have a look at that. IGWD. And what I'll do is I'll look at it on SharePad. So just give me a moment as I flip between screens here. And then I'm going to appear in the bottom right. So let's have a look. IGWD. So clearly I did a video about sterling hedging recently. And if you are a UK investor and you invest in the US, sterling clearly has taken a big pounding over the course of this year. Now that means that, you know, if we'd bought US stocks at the beginning of the year, we didn't lose as much as US investors. In fact, for us, it's not even a correction right now for the S&P, because sterling's weakened so much, it's flattered the value of the S&P because it's in dollars. So let's have a look at the value of this thing. Let's have a look at the description first, just to see a little bit about the fund. So the fee for this thing is 0.55, so that's a pretty expensive one. I'm sure there are cheaper MSCI World funds. Maybe not. But anyway, 0.55 is pretty steep for MSCI World. Remember, MSCI World is just developed markets, and usually the fee for developed markets is quite low. So it might be worth having a quick look just to see if there's something a little bit cheaper on just ETF, which is free, right? So let's have a quick look at equity. In fact, what we could do is do it by index. So let's do MSCI World. MSCI World. We'll get there. MSCI World. Here we go. Sterling hedged. Have we got one? Oh, we've got three. And we'll sort by expense ratio. So there are three of these funds. The cheapest one is X-Trackers, and the fee for that's 0.29. So none of them are very cheap. But yeah, I think, yeah, they're surprisingly expensive. So 0.29 is the cheapest. So yeah, you might be able to get, I think there is a cheaper one, which is a US tracker, which is a US equity market tracker. But yeah, if you are going to do that, then, you know, I think the reason why that makes sense at the moment is sterling has strengthened after the mini budget. the purchasing power parity for sterling puts it at something like 144. So you'll lose about 20% in return if sterling does strengthen to its PPP value. But of course, that can take decades. Or there could be other crises which mean that the UK stays weak as a currency. But certainly, based on what the Fed said today, the interest rate differential will still remain in place for some time to come. The Fed's still going to be more aggressive than other central banks. It's got a stronger economy, and that strengthens the dollar because it's this rate differential which is driving the currencies. So, you're going to have time to put the hedge on, put it that way. But should you do it, I think probably, it could be an interesting thing to do if you think sterling's going to strengthen. Personally, I think it's going to stay weak for a while. But yeah, if you look at PPP, it should be stronger. So watch my video about that, about sterling hedging and the UK's secret weapon for investing, which is a weakening currency. Brilliant. So we also have a question from, from Abdul Khan, a super chat. Thank you, Abdul, who says, and it looks like Abdul's in Canada, can you elaborate on the leverage filter on quality? Yeah, sure. Let's have a look. So if we look at just a standard quality index, right? So MSCI USA quality, say. If you look at a global one, it's similar, right? So let's look at the criteria. So this is how that index is run. So the quality index is the blue line, MSCI USA is the yellow line, and you can see it's outperformed. But if you look over the course of this year, then quality is down 21%, whereas MSCI USA only 17%, right? So you can see that quality hasn't been a great style over the course of this year. It's really underperformed. But long term, this is an outperforming factor. So how does it work? Well, there are 3 quality criteria that it uses to screen stocks. So it takes the MSCI USA index, that's the kind of parent index, and then it crosses things off. What does it cross off? Well, it's based on this score. It's got to have high return on equity. In other words, the earnings per unit of equity have to be high. Stable year-on-year growth in those earnings. So you want steady increase in profits. Clearly, that's a good thing for a company. And also low financial leverage. So if you look at the amount of debt on the balance sheet and divide it maybe by the size of the balance sheet. So let's say that, I don't know, it has a lot of bonds which it's issued, and that's how the company's funded through a huge amount of debt. Then that's risky, because if it can't service that debt, if its revenue falls, the company will default. So that's a low quality company with a lot of leverage. And a lot of the junk bond funds are stuffed full of these companies with a lot of balance sheet leverage, which may not be able to service the debt if they have to roll it over at these higher rates. So default rates, I think, are going to pick up a lot. And there was a Swiss Re report recently which talked about a kind of adverse scenario for credit where things could really pick up for defaults. So that is a pretty scary prospect over the course of this year. But I think quality is an interesting style. I think that's one that'll probably do well through this kind of volatile period. That's just a guess, not a recommendation. But anyway, I hope that's helpful, Abdul. There's another one from Super Chat from Ray. Thank you, Ray, who's in the UK, because it's in sterling. Brilliant. Isn't the market still quite high if we're expecting still a few percentage Fed increases to come? Love watching and listening to these videos. Oh, that's really kind of you. Thank you, Ray. Well, yes, I think is the answer to your question. I mean, let's have a look at another thing. Let me just quickly share this because I think it's kind of interesting. Now, Robert Shiller has a measure of valuation called the CAPE measure. And if we go back to the things here, stock valuation, and I'll appear in the bottom right hand corner here. So this is the valuation tab. If you're a member of PensionCraft, you get access to these tools. So this is the forward PE. This is the Shiller Cape, which looks at the price of the S&P divided by the profits over the previous decade. You can see it's a pretty good bubble detector. It picked up 2000. It picked up the dot-com bubble. It picked up the recent the bubble after the pandemic, and it's currently still elevated. But a lot of people criticised it because they said, well, if interest rates are low, real interest rates, then you should adjust for that. So what Shiller did is he inverted the CAPE measure so it becomes like an earnings yield, and he subtracted the real 10-year yield. So what this is like the earnings yield of the S&P. Like CAPE, it looks back over a 10-year period for the earnings, but it subtracts the real rate of interest over that same period, 10 years. So when things are cheap, when the stock market's cheap, you get a high value for CAPE yield, excess CAPE yield. And when markets are expensive, you get a low value of excess CAPE yield. And what's interesting is if you adjust for interest rates, it's starting to look a little bit expensive. So the median, the kind of neutral level, is 3.5. And currently it's at 2. So it's just getting into the little bit expensive range. According to CAPE, it's super expensive still. And according to forward PE, then, it's below the 10-year average CAPE measure. And this is as of the 28th of October, which is the last time I updated it. So I'd say that in terms of real yield, if you adjust for real yield, markets are still looking pretty expensive, not cheap. And if the Fed's going to get that much more aggressive, look at what happened to markets today. The reaction was negative, particularly for those growthy stocks which hate higher interest rates. It looks like we've got more pain to come. I agree with you there. But look, I am getting more aggressive in my portfolio. I'm buying more equity. I'm buying it faster. And I've recently bought small cap stocks in the US. And I've also bought Scottish Mortgage, a little bit of that, which is like our version of ARC in the UK, but with more governance. But it also buys disruptive companies. It's a little bit leveraged. It's an investment trust. And, I am becoming more greedy now that markets are more reasonably priced. But fortunately, I have some cash to deploy to do that. Right. We've got one more question, and I think we'll wrap it up there because it's been a long time. Okay. This is supposed to be short. So Maria Lucia Clorastianu Raphael, who is one of our supporters on PensionCraft, thank you for that. We've got a little crown next to your name. Says, is investing in USA funds as US equity fund still a better idea than a UK fund? Well, look, if you're a US investor right now, the UK is looking very cheap. Not only because its price to earnings ratio, the forward price to earnings ratio is low, which it is. In fact, it's one of the cheapest countries in Europe right now, for developed Europe. Simultaneously, the currency is also depressed because of Brexit, because of the recent mini budget, although that quickly recovered, but also because of the current account deficit and the perceived economic weakness of the UK. Is that always going to be the case? No. I think the UK will recover. It just has to find its feet. So certainly I think for a US investor, the UK is looking attractive. And if you look at the dividend yield for the UK, it's very high. Historically, it's been a good dividend payer. So if you like dividends, you like buying cheap stocks, and you like the possibility that sterling's going to strengthen, then for a US investor, there are lots of positives. For a UK investor, the currency thing doesn't really affect it that much if it's domestic companies. So if you go for the FTSE 250, for example, it's largely domestic revenue. But, it's looking cheap. It pays a high dividend, and it is depressed right now, perhaps a bit too depressed relative to where it should be. So, Yeah, I think the UK is certainly much more attractive than it was, just 6 months ago. But that's because it sold off a lot. But the UK is going to go through a rough period, no question, because the Met Office has just come out with a warning that it's going to be a cold winter. So the video for this Saturday is going to talk about that. And, that could be quite difficult for the UK because we have very little gas storage in the UK. And a lot of businesses will struggle to cope with the heating bills. So pubs, for example, you wouldn't have thought of it being energy dependent, but they have to heat the pub in winter. And if they can't afford to do that, then, they have to cook the food if they offer food. So that's going to be a real problem. So a lot of companies, I think, will struggle. And the government isn't in a mood to be very helpful anymore because it's, I think it's punch drunk from trying to bail out, jobs, companies after the pandemic. And they're now talking about austerity, about filling the fiscal black hole. So, we've got austerity, high inflation, and a very poor energy infrastructure with very little storage of gas, which was a political choice. So I think the UK could still have a rough period ahead, but there could be some better valuation points ahead when it will get very, very cheap, and I think it could be very, very attractive. But I think there's still a bit more pain to come. Let's see what happens in the winter, how cold it gets. I know it's weird to say it depends on the weather, but I think it will. Anyway, look, let's draw a line under it there. The overall message from the Fed, just to summarize again, is expect higher rates, expect more aggression in terms of policy stance, and it's too premature to discuss pausing raising interest rates. That's very clear. That's the message that Jerome Powell wanted to convey. And, that's not good for stocks. And we saw the market reaction was negative, and you can see why. Anyway, look, please do become a member, and then, we can discuss this stuff in our forums. That's what we typically do. We talk about things on Slack, and you can also book a power hour with me, one-to-one, and you can do that on our website, PensionCraft.com, and you can also learn about our membership there. So please do consider joining us. We'd love to have you as part of the community where we have these discussions all the time. So thank you for joining us. It's been a real pleasure to have you with us, and we'll see you again soon. And watch out for my video on Saturday. Please do subscribe as well on YouTube. Take care, everyone.